Bismillahirrahmanirrahim. Subject is financial management, and this is third lecture on valuation of long-term securities. Today we will discuss common stock valuation model, dividend discount model with zero growth, dividend discount model with constant growth, dividend discount model with zero growth and with maturity or with sale price. So moving further, common stock or share valuation. Common stock, what is common stock? Basically, common stock represents the ownership claim of the holder on the company. It represents residual ownership position. Residual ownership means in case of liquidation, this owner claim will come after paying to each and every individual claim holder. Let's suppose in case of liquidation, if the company becomes liquidate and liquidator will start selling their assets gradually, and the amount or the proceeds coming from these disposing of these assets, then he will pay first of all government taxes, then short-term obligation like account payables, then he will pay the long-term obligation like bank loan or like bond, and then the proceed from disposal of asset will be used to pay preferred shareholder, and then in the last the residuals that remain with the liquidator, it will be paid to the common shareholder. So what cash flow will shareholder receive when owning a share of common stock? We will discuss, and these cash flow are basically used for valuation of common stock holders. These are future dividend, that if anybody XYZ who hold a common stock will receive dividend on this common share on future, and he will get some amount from the sale of the common stock in future. So it means if you buy a shares, you may easily dispose it if you need a cash in the future, so it will give you liquidity as well. But usually people when start investing in the shares, they perceive they plan two things. One is, let's suppose you buy a share on 10 rupees in 2000, let's suppose in 2019. In 2019, and at the end or at the start of 2020 you sell it for, in 2020 let's suppose you sell it for 15 rupees, and in the meanwhile the company declare a dividend of 2 rupees on this shares. Now this person, Mr. X or Mr. Y, who bought this shares in 2019, get this dividend and sell it on 15 rupees. So he also receives 5 rupees from price appreciation. Total he receives is 7 rupees on investing 10 rupees. So what is his return? This 7 on 10 means 70% return he got in 1 year. This is just an example of only that much returns are rarely earned by the investors. So future sale of the common stock share, there are two things, that two sources of cash flow that the shareholder will receive from holding the shares. Now, what should be the valuation? What should be the intrinsic value, or what ought to be the value of the common share is depend on cash flow model. First model is dividend discount model. What is dividend discount model? If we discounted all the future cash flow of dividend, this will give us the intrinsic value of the common shares. So that should be the intrinsic value that one ought to pay for that common share when we get discounted all the future dividend to the present value on some discounted amount. So if let's just assume that you have a share of a companies who give you dividend after 1 year, and then give dividend after second year, then give you a dividend till infinity, because we consider the company as going concerns. So what we will do, what should be the value? We will discount this first year dividend on equity discounted rate, that is required rate of investors. Second year dividend will be discounted, means at present value will be calculated. So when we calculate this present value and then sum it up, it will be the value of the common share. But mathematically it is not easier to calculate the value of present value till infinity. So maths gave you a very short short formula. This is basically summation from 1 to infinity dividend divided by 1 plus KE, means 1 plus KE required rate of return. But this is not the formula. We will get a short reduced formula, which will be equal to dividend divided by KE, which is perpetuity formula we discussed in earlier lecture as well. So that will be the value for those assets who provide your cash flow for infinity, but of an equal amount, or it is called also perpetuity, when the asset provides you, or you paid or received equal amount after equal interval and forever. It's called perpetuity. That is the basically formula of the perpetuity. Dividend divided by required rate of return. So dividend T means cash dividend at time T, equity investors required rate of return. Moving further, dividend discount model with sale price. Let's suppose if an investor assume that I will hold any share for 5 years, then I will sell it after 5 years. So the shares will provide him dividend for 5 years, and then sale price as well on the 5th year. 1, 2, 3, 4, 5 dividend each year. This year dividend, this year dividend, this year dividend. The investor or the shareholder will receive dividend for these 5 years, and in the 5th year they will provide dividend as well as sale price. Two cash flow will occur at the 5th year. We will discuss this model. This is how the same model, but with one changes. Dividend in first year, we will discount it on required rate of return. Dividend on second year, we will discount it on a second required rate of return for the second year. Discounted and compounded have been already taught to you in first 5 or 6 lecture, and we will solve the problem of the second chapters. So we will discount on the last year 2 things. One is price of that shares and dividend of the share and required rate of return. So all these discounted value give you an intrinsic value that should investor pay to buy that shares. Now, N is the year in which the firm's share are expected to be sold, as I told you earlier, and price is expected share price in the N year. So all these things are about the future. This dividend are futuristic, this dividend is futuristic, and these all things are based on expectations. So we will discount all these expected values, and then we will be in a position that how much we should pay to the common shares right now. Dividend growth assumption. Let me remind you that bond have coupon value. As we discussed earlier, there is no changes in bond interest. Bond interest are certain for the future. So any increase or decrease in the market will not influence bond interest. Similarly, preferred share dividend are also mentioned in advance. Let's suppose preferred share dividend are like this: 8% preferred share dividend, 10% preferred share dividend, similarly. So these two things, not bond coupon rate nor dividend preferred share dividend rate, are changes. But in case of common shares, it is totally on the prerogatives of the board of directors who will approve dividend for the common share in each annual general meeting. And the company may maintain growth rate, means in first year it may be $2 per share, in the second year it may be $2.5 per share. Similarly, the company may give rise each year to the dividend. So we can't assume that the dividend will be constant for 10 years, for 5 years, so it will be increases. So we will also assume the growth rate in our dividend discount model. So in growth rate, we will discuss three models. One is constant growth. Maybe the growth for the first year is 10% increase, 12% increase, and then for the let's suppose for the first 5 years, maybe the growth rate may be the same for 10%, and then after a 5 year, it may decrease to 8% for next 5 years, and then maybe decrease to 3%. So this growth rate may not be the same. Second is, so first we will discuss the constant growth rate, constant forever. No growth, maybe there is no growth at all. And the third is maybe the growth phases, means as we discussed, it might be for the first 3 years it may be 4%, and then afterward it may go to for the next 3 years it might be, let's suppose, 8%. So this is for the next 3 years, and then maybe let's suppose 9% for the next 10 years. This is called growth phases. We will discuss each model in detail. Constant growth model. The constant growth model assumes dividend will grow forever at rate of G. G is just a denotions or a symbol used for the growth. We will assume that the dividend will grow at one rate, means at a constant rate. So what we will do, if we have a dividend at year 0, dividend 1 will be equal to 1 plus growth rate with multiplication of D naught. The second year dividend will be D naught 1 plus G raised to the power 2 that is the second year dividend. Similarly, d naught 1 plus g raised to the power infinity, that is dividend at infinite period. We will discount all these dividend that growing with growth rate g with discount rate or equity required rate of return or equity shareholder investor required rate of return. So this is one of the reduced forms that the value, if we reduce this is basically mathematical, secondary school mathematics is involved to reduce this whole model to d1 divided by ke minus g. What are these three things? This dividend is basically dividend paid at time 1, means if you are standing at time 0, the d1 will be the dividend at the end of the year or at the start of the next year. This g is basically the constant growth rate at which the dividend are going to increase. K is basically investor required rate of return. This is constant growth model. We will discuss in the next slide an example on constant growth rate examples. Stock CG has expected dividend growth rate of 8%. So G is how much? G is this 8%. Each share of the stock has just received an annual dividend. Just received means this is D naught. Right now they received how much dividend? That is D naught. We will convert this D naught into D1. The appropriate discount rate is, this is basically KE. So what is the value of the common stock? Means how much you are willing to pay to this common share of CG stock. If it gave you a growth rate in dividend 8% and your required rate of return is 15%, and today dividend is $3.24, what should be the value? We will use constant growth model equation. So D1 is equal to, as I told you, that this is D naught. Sorry, this is D naught. So D naught into 1 plus G, this formula is like this, into 1 plus G. Putting value in it, we will get $3.24, 1 plus 0.08, 1 plus G. This D1 becomes how much? $3.5. So this is the value for constant growth model is D1 divided by KE minus G. Putting values, D1 is 3.5, K is, as I told you, 15%, 0.05, G is 0.08. When we calculate it, that is $50. So the value of this stock is mentioned above should be $50. Now moving zero growth model, the same model. What is zero growth model? Zero growth model is basically based on assumptions that the dividend will grow forever at G is equal to 0. So mean there will be no growth rate at the dividend. Dividend will remain a constant. Means if dividend is rupees 5 at first year, 5 rupees per share, then it will be 5 rupees per share for coming year as well. So same growth rate, but there is no G because G is 0, so it will become like this. Zero growth model is then reduce to this perpetuity model, that P1 divided by KE. If there is zero growth model, so all these will be equal to D1 and D1. If there is no increase, so D1 will be here as well, D1 be here as well. You may say that it should be only a D, because if there is no growth, why we call it D1 and D2 and D3, but this D1 is just denoted the year of the dividend. So in year 2 and year 3, these dividend are constant and same. So this is the formula for zero growth model, which is called formula of the perpetuity. In perpetuity means when you receive same amount after equal interval of time and forever, means for to infinity, it is called perpetuity. So dividend formula is dividend paid at time D1 and KE as investor required rate of return. This formula will be used in coming example. Again, let's suppose stock ZG has expected growth rate of 0%. Each share of stock just received how much? The same example, 3.24 dividend per shares. The appropriate discount rate is same again. What is the value of the common stock? That is requirement. So using the formula, D1 is equal to 3.241 plus I, 3.24. Again the same as I told you. There is no growth rate. So if you are using the same formula, G is 0, we will use this formula, D divided by KE. So 3.24 divided by 0.15, that is $21. So investor will buy to pay $21 for this type of share if it have no growth rate in a dividend. Means the 50, why of the $50? The $50 is for the growth of 8%, because the dividend was not constant. In future the investor will receive more cash, but in case of zero growth rate, the investor will not receive then extra cash in this zero growth model. Dividend growth phases model. What is this? Growth phases model is based on assumption that dividend for each share will grow at two or more different growth rates. It is possible that the dividend in future may grow at a different rate. This is basically mathematical formula that from T to T 1 to N, it is grow at a rate of G1. So we will use T is equal to 1 up to N, 1 plus K e raised to the power T, and this is T. This will take value of 1, 2, 3, 4 till N. And then second starts from N plus 1 to infinity, Dn into 1 plus G2, that is second growth rate, T2. And this is this T will take a value of from N plus 1 till infinity. So there is no shortcut formula. We will calculate and involve laborious calculations in this growth phase model. Examples. Stock of GP means growth phase model has an expected growth rate of 16% for the first 3 years. This is called G1. For first 3 years, it will how much? It will 16% and 8% for thereafter. This is called G2. Each share of the stock just received a dividend of 3.24 dividend per share. The appropriate discount rate is 15%. What is the value of common share in this stock under this scenario? So there are two growth rates. One is 16% for the first 3 years, and then 8% for then after 3 years till infinity. So this situation in a timeline will be like this. This D1 will be get by using this 16% growth rate. D2 will be using this rate. D3 will be using this rates. So how we will get this one? This is called basically a dividend D naught. D naught is this one. So D1 will be equal to D naught into 1 plus G1. So what is G1? G1 is basically 16%. But this dividend 4 will be calculated as D4 is equal to, for this D4, this D3 will be called D naught. So D3 into 1 plus G2 raised to the power 1. So this is basically what we are going to calculate our dividend. This is first phase and this is second phase till infinity. Stock GP has two phases of growth. The first is 16% started from T is equal to 0 for 3 years and followed by 8% thereafter. Starting at time T3, we should view the timeline as two separate timeline and valuation. Dividend growth model. So first we will calculate present value of this D1, D2 and D3 by discounting unrequired rate of return, and then we will calculate the value for this second phase. So we will use constant growth model formula. We will get present value of the share at time 3 till infinity, and we will further discount this value at 3 to value 0. Because we are standing here at 3, at year 3, we will discounted all these constant growth model. Note that we can value phase 2 using constant growth model. Now coming to the dividend growth model. So first phase is this one. We will get present value of the these dividend, and then the second phase will give us value of the share but at time 3, because the second phase forever is started from this 3 year and onward. For value 3, D4 is, this is basically like this. V at time 0 is equal to D1 divided by K minus G. But we will replace in this formula, this D1 will become a D4 because we are going to calculate the value at the end of the year 3. So we will call it year 3. So this will become 4 and this is KE and this is G2. Now we only need to find first 4 dividend to calculate necessary cash flow. So growth rate model. We are basically interested in dividend D naught. So D naught 1 plus g1 raised to the power 1, that is d1, 1 plus g1 raised to the power 2, g2, and this is d3, 1 plus g1 raised to the power 3, this is dividend at the end of 3. But for dividend 4, since growth rate have been changed, we will use d3, this amount, as d1, because this amount will grow now further at a rate of g, which is 8%. So up till 3 years the dividend was 16%. Now this amount will grow at 10% in the next year. This is basically D4, which is required in our growth phase model. Now this dividend will be discounted at a rate of 15% to 0. This dividend will be discounted to the rate of 15%, at the rate of 15% to 0. This is, but here at this timeline we will get V3 of the second phase as well, which will be also discounted to the 0. Now dividend discount model gave us this $78 value of second phase, which is constant growth model 5.46, that is D4, and this is 15% required rate of return, and this is what is growth rate G2. So it gave us $78, but this $78 is not present value. It is the present value at the time, at the end of the year of third year. So we will also discount this $78 to 0. Now we will only need to find the first 4 dividend to calculate the necessary cash flow. So present value of the D1 is, that is first phase value, this is D1 present value, discounted factor of 15%, means present value interest factor for second year present value. We will get these value from the table of present value interest factor of single amount, not an annuity table. We will check it in a single amount. So that is 3.3. This is, if we add these all things, that will be the value of the first phase. Now P3 is equal to 5.4 divided by 0.5 minus 18, $78 growth model value. But we will discount this to the 0. So 15% for third year, P3 price of the share, which is equal to 51. When we add up all these amount, it will give us the present value of the common share. 51 plus 3, that is equal to 54, 57, and 60, and this is round about $61.5 per share will be the value of the common stock. We will add this amount with all these 3 which will give us the present value of the stock that our investor should pay to buy this common shares. Thank you. This was all about today's lecture. See you in a coming lecture.